Hi, everyone. Good afternoon. Thank you for joining for a very quick brief on our 2Q, post 2Q market update. The title is Can AI Alone Power Markets? And I say that because the second quarter was dominated by AI companies' performance. Quick disclaimer, this is not investment advice, it's really educational and informational purposes only. If you need to reach us, we'll have this slide at the end as well. The next 12 or 13 slides will cover these bullets. As you can see, because we're looking back to start with, it's really a lot of discussion around AI and the capital spending that's ongoing, because that's been the primary driver of the US market in the second quarter, and to an extent, year to date as well, but particularly in the second quarter. A quick look. Don't forget, this is the bottom in late April, so this is second quarter. You can see the amazing performance of the AI stocks. The SMH ETF in the second quarter was up something like 70%. Actually, no, up something like 70% year to date, but the second quarter was up, a good amount of that. The There is clearly a lot of revenue that's driving into the AI stocks, but it's also kind of normalizing dip buying and the recency bias of buying every dip. And that's something, we'd want to watch out for. The share prices have followed really strong earnings estimate growth. And the black line is this year. But it's not only that, we as in Wall Street is projecting really sharp earnings growth into 27 and 28, kind of just as this year has gone up. And that seems a little riskier just because we don't know what's going to happen with capital spending for the coming years. I mean, as an example, Samsung Electronics has recently said that this year's profits for their semiconductor business would surpass, the single year would surpass the last 40 years of cumulative earnings, and kind of gives you the sense of how much things have inflected higher. A couple of headlines here. The Samsung mention I just talked about. DRAM prices surging 2,200%, in a very short period of time, and that the AI giants, we want to call them, are handing out free usage because they do want to get services going. And even 20-year-old DRAM, which is this memory used for some of the compute, which was essentially worthless not too long ago, has gone up. This is the top left chart, quite sharply over the last few months, year to date, really. So it's something, it seems unsustainable, and it's probably not going to be sustainable as well. The bullish side is that AI spending, everyone's talking about it, myself included, it is still a very small percentage of GDP. It's 0.4% of GDP. In contrast, the IT sector is almost 10%. Revenues have grown a lot. The question remains profitability, and there it's less clear. Again, just to highlight, right? I've shown this chart before in prior quarters. You have seen a substantial increase in capital spending, and most of the profits have really accrued to the upstream, the equipment providers, the semiconductor companies, and it hasn't really gone into the AI companies themselves. They're getting revenues, and for the moment, we're happy to pay up share price wise for the revenues that are coming through. Interestingly, this is a year-to-date chart. Despite all this excitement and you might even say noise around AI, you have seen a very quiet broadening of performance. The blue line is the large cap value, which is done better than the S&P. S&P is green, up about 10%. When I did this chart a few days ago, even the equal weight, the RSP light green line is better. And much of that performance, the broadening has come because the Magnificent Seven stocks, this is the MAGS ETF, has underperformed. It has caught up over the last few days as global risk because of the Straits of Hormuz have kind of picked up again. But this is an encouraging sign and something I think you should expect to happen if AI is real and the improvements and the efficiency gains will impact a broader subset of or broader economy, really. When I talk about, will capital spending by the AI companies and the hyperscalers sustain, this is one of the charts that really strikes me as um, pointing to the difficulty of maintaining the capital spending because, a year and a half ago, everyone was saying, oh, these are companies, they're using their free cash flow to spend on their AI Capex. Um, Free cash flows went to zero. Then they stopped the buybacks, and this is a chart that shows the buybacks. And at the moment, Microsoft's the only one doing a buyback, which means less support for share prices. And what I don't have the chart here, but if you look at these same companies, they're now issuing large billions of dollars of debt. Amazon just issued $25 billion this week. They now have $100 billion of debt outstanding from almost nothing, 18 months ago. So that makes it riskier to assume that these capital spending numbers will continue, certainly would challenge the view that they will increase further. And the other part is, this is a chart of it says equity issue, new share issuances. And what you're seeing is a big spike in new supply. I would note here this big $1.2 trillion bar is mostly SpaceX shares getting unlocked. It's not that every share that gets unlocked gets sold, but it is still a risk that the market has not faced over the last, 5 to 10 years, really. Just talking about the excess that you might see in the market. And this is a chart of the total assets of companies that or assets are under management for leveraged ETFs. We now have 3 times levered single company ETFs. It was to me encouraging to see that in I think December last year, the SEC came out and told the industry to stop, that they were not going to approve these 5 times levered ETFs. And these were the companies filed to issue 5 times levered ETFs on single companies like Tesla, like Coinbase, on pretty volatile companies. So there's no denying that the markets are being impacted both in the upside and the downside by this leverage strategies. And in terms of buying the dip or just overall leverage or debt being used to buy shares. This is a chart of US margin loans relative to GDP. I mean, lots of people show a margin loan chart, it just goes up. The better lens is to look at it relative to GDP. And you can see, it's at an all-time high. I've kind of shown the prior peaks. These also make it just a warning sign. It does not indicate anything that happens over the next 6 months or any time period, but it again shows that people are using lots of margin loans to support their positions. The last 2 slides that I'm going to talk about, these are well, known and worn, and people have talked about it. I've certainly talked about it, and it's the government debt. This is just a chart just showing how much it has gone up. One of the things that makes this material going forward is that for all the talk from the new Fed chair that he may have to raise rates to get inflation under control, this total, because of how much debt we have, and how much our interest payments are. Some this year is running around $1.1 trillion dollars. That it makes it the second largest item in the budget after Social Security. Raising rates materially is a highly unlikely probability because the interest payments will quickly get up to 1.5 trillion or more because we have been funding most of our debt in at 12 months or less. So that's something I keep focusing on. It is not necessarily something that matters on a 1 to 2 year view, but on a longer term view, something that I continue to think is important to keep in mind. And finally, why is government debt going up? It's a record deficit. We have bipartisan support for spending now. For our audience of retirees, the Social Security Trust Fund is set to empty in 2032. If the government does nothing, it would lead to roughly a 23% benefit cut across the board. I think it's highly unlikely that that happens because that will be political suicide for all of Congress, regardless of party. But it's something, I think will only get tackled at the 11th hour with a band-aid solution instead of a proper solution that we had. For example, in 1983, we had reforms to Social Security, which we've all been able to absorb without very smoothly, really. So that's kind of the last of my slides. In conclusion, you know, the message is, I think there's more ways to win than just AI. The AI spending has driven share price performance into a very small handful of stocks, but I think the overall spending and the innovation and efficiency should be very positive for broader economic growth and all of the listed companies that are out there. And you're seeing it in terms of broadening performance. Small caps have done better than the S&P. Equal weighted S&P has done better, and even value has done better. What the data says, what we need to be cautious about is margin debt is at a record high. Corporate debt is rising because of this AI Capex, and government debt has always, has been high and continues to go higher. And AI earnings, the question is, it's concentrated. The shares have done incredibly well. And so that's where my concern is that, hey, there's expectations that both earnings and share prices will continue to catapult higher for this small group of companies, and I'm less certain about that. What are we doing about it? We want to maintain the capacity to add. It is not a signal to sell. We like the broadening idea, value, dividends, international. International should do better now that the oil price is under control. Fixed income, I've said this for several, maybe over a year now. We want to be, both with inflation protection tips, short and intermediate treasuries. We don't like long term because of the high deficits and the high debt. And for longer term, I think it makes sense to own your favorite scarce asset to benefit or to really to hedge any risks coming from the US debt and rising and what that would do for monetary policy. So I'm going to stop there. If you have questions, Alex and I are available. Our details are right here. But thank you very much for going through these slides with me. Take care. Bye.